Now let's think about our income statement. Some items are just tied to sales. If your sales go up and if you keep doing business the same way you have been doing, there are some things that are just going to naturally go up. Sales go up, cost of goods sold goes up. If sales go up by 20% and everything else remains the same and I do business the same way, my cost of goods sold is probably going to go up by 20%. If my sales go up by 20%, then I'm going to probably need 20% more workers. And if I pay them in the same way I have been paying my workers in the past, my wage expense will probably go up by 20%. My electricity, I'll probably, if I do 20% more activity in my business, I'll probably use 20% more electricity, so my utilities bills will go up. Administrative expenses, I've got some question marks here, because think about your rent, for example. Say I'm renting my building. My sales go up by 20%, is my rent going to go up? No, my rent might just be fixed, unless I have to rent a newer, bigger building. So administrative expenses, some might not change at all if my sales go up by 20%. Some might go up. So I'm going to put question marks here, and let's just do this. Let's just assume, for simplicity here, as outsiders looking at this business, Darrell company that we're going to forecast net income for and prepare a pro forma income statement and balance sheet, let's assume that the best we can do is if sales go up by 20%, then these administrative expenses and other operating expenses are going to go up by 20%, but realizing that if we had detailed data of the individual expense items, we might be able to do a little bit better. This one will go up by 20%. This one probably stay about the same if it's rent or something else. So let's make the simplifying assumption that these kind of things that we don't have any more detail about are going to go up by 20%, but realize that there's something a little more subtle going on there. But we won't deal with it now in just this simple introductory example that we're doing. How about depreciation? Depreciation increases with a property, plant, and equipment increase, and that does not necessarily mean that that's going to coincide with a sales increase immediately. Now, if my sales keep going up each year, eventually my property, plant, and equipment is going to go up, but it doesn't have to happen in lockstep. Maybe I expand my property, plant, and equipment this year, and then I grow into it with sales increases in future years, and 5 years from now, boy, I build a larger plant and spend a lot of money, and then my sales go into that. So it doesn't necessarily coincide immediately. For example, I could have a sales increase with no new property, plant, and equipment. Just use the surplus capacity that I've already got. So even though my sales go up, I got the same depreciation. Or my sales might be flat, but I decide I'm planning for the future, so I build new or buy new property, plant, and equipment, so my depreciation will go up even though sales will flat. So you don't look at sales to tell you what's happened to depreciation expense next year. You look at what's your plan for property, plant, and equipment next year. That will tell you what your depreciation expense is going to do next year. Interest. Interest increases as your loans increase, and that doesn't necessarily match up with your sales. You might finance your expansion, you buy new buildings, what have you, with borrowed money or with shareholder invested money or a mix of both or whatever. So it's not necessarily the case that a bigger business means more interest expense. It could be that you could have a sales increase with no new loans. It could all be financed through other means. Well, if you don't have any new loans, it doesn't matter that your sales went up. No new loans means your interest expense is going to be the same as it was. You get the same old loans as you always have. Your sales are flat, but you might decide you want new loans. Maybe you're replacing some investor financing with some debt financing. Or maybe your sales are flat, but you're going to build new buildings and buy new equipment, so you're going to borrow money to do that. So even though your sales are flat, maybe your interest expense goes up if you finance that with new loans. The point is this. To figure out what's going to happen to your interest expense, don't look at sales, look at what happens with your loans. That'll tell you whether your interest expense is going to remain the same or go up or go down. Income tax expense increases as our income before income taxes increases. And our best assumption is that the income tax rate remains the same. So what is the income tax rate? The income tax rate is my income tax expense divided by my income before taxes. So let's say that my income tax expense is $40 and my income before taxes was $100. That tells me that the income tax rate is 40%. So if next year I think, and I'll call it income before taxes, next year I think my income before taxes is going to be $150. What's going to be my income tax expense? Well, my best assumption is that the rate's going to be the same. So if my income before taxes is expected to be $150, I think my best assumption is that the income tax rate's going to remain the same, so my income tax expense would be $60. The important point is, when I'm looking at forecasting income tax expense, I look at two things. What's my income before taxes, and what's my income tax rate? Those will be the variables that I'll use to forecast my income tax expense. So we're going to construct pro forma financial statements for this hypothetical company, Darrell Company. Here are our initial assumptions, and I put initial and I underline it, and I'm going to circle it here 1,000,000 times. There you go. Initial. This is just a forecast. We're seeing it as an initial pass. How does it look? Because the point of doing pro forma or projected or forecasted financial statements is let's do it on paper first, do some initial assumptions, and see how it looks. If it doesn't look good, let's just change the assumptions. It's easier to change something on paper than it is to wait till you're in the middle of it and try to change it. So these are initial assumptions. Our initial assumptions are, looks like our sales are going to go up 40% next year compared to this year. Our plan is, our capital expansion plan is we're going to have a net increase in property, plant, and equipment of 200. So we're going to replace what depreciates and increase 200 above that. Loans, we're going to have our existing loans, and then we're going to have another $224 in new loans. And we're going to plan to pay dividends of $6 initially. We're going to do that. So those are initial assumptions. And the amazing thing is this. Given last year's balance sheet, last year's income statement, and these 4 initial assumptions, we can now project what next year's financial statements are going to look like before the year ever happens. I think this is amazing.